All right, y'all. Welcome back. This is Acquire and Operate Micro SaaS. Happy holidays. We got to maybe cut in a little bit of, Talib Kweli, like recording live from somewhere.
Yep, yep.
So I guess for any of the listeners out there, if you are a creative that dials in intro, outros for podcasts, we can maybe use a little facelift. So get at me.
Yes, sir.
But headline today, I went with a provocative title. I was like, this needs to be a little more provocative. At the beginning, it was like Triangulating Valuation, a practical guide. And I was like, ooh, I barely know what that means. So we landed on every
Not gonna click
SaaS
on that.
founder needs a point of view on valuation, practical methods, and a 15-minute calculator. So do you feel provocatized?
I was gonna say, if I see that pop up on my timeline, I'm more than likely to click that than triangulate anything.
We're trying to put more energy towards those elements. But in
Yes.
terms of a table of contents or an agenda for today, we are going to, as the title noted, kind of talk through some, or I guess, well, yes, table of contents. We're going to talk through some practical methods, and then, it's anchored around net present value, which is a concept that intimidates a lot of people, and hopefully we kind of debunk that. We're going to talk about utilizing benchmarks to establish a relative point of view, and then we're going to talk about how you consolidate, or how you kind of, where the term triangulate comes from is you kind of you establish a blended point of view on valuation as a function of the net present value of the business, an ARR multiple, and an EBITDA multiple. And then, of course, in the Substack, we have a link to a valuation calculator that is meant to be as straightforward and easy, and while also being, very data-driven and extremely rational calculator that, assuming you have access to your metrics, it should take you no more than 15 minutes. So that's the headline. That's the table of contents. That's where we're going. And I guess for a little bit of context, and I think, or I guess it's kind of tragic that the majority of SaaS founders, if you ask them what their valuation is, they're like, well, I read an article that it's like 6 times ARR. So, we're probably valued at XYZ. And there's not a lot of confidence in that. And the sad part is that for the vast majority of these founders, their net worth, 80, 90, 100% of their net worth is in their SaaS business. And if by way of so it's like, like Drake said, know your worth. And it's like, you're not even, or like this whole kind of tranche of humans that's creating tremendous value in society and delivering value to businesses, et cetera, is a little bit flying blind when it comes to the value of their greatest asset and the biggest driver of their net worth. And so my hope is that we can change that. So it's, it's more like akin to, and I guess by way of analogy, the average American, the vast majority of their net worth is tied up in their home. And if you want to know what your home's worth, you jump on Zillow and get a Zestimate or whatever and lickety split. And it's all public data, public record. It's very easy. So the hope here is to enable founders to move with way more knowledge and understand, okay, our business is worth this. This opens up opportunities for financing. If we improve these metrics, it's going to have this kind of impact on valuation, and that can inform game plans, OKRs, all kinds of stuff. And then, I guess in the most macro sense, knowledge is power. So the hope is that this calculator, that this post will really do a lot to simplify a whole bunch of stuff that I think, honestly, and I guess I have a chip on my shoulder this way, like so much of this stuff I think is like the terminology is like intentionally meant to intimidate people. Where it's like, oh, you've got to be an investment banker or you need an MBA to understand this stuff. And once you start to break it down, it's like, damn, that whole thing is one formula in Google Sheets. It's literally XIRR equals, or it's equals NPV. It's like, wow, I thought that this would, required really, really robust modeling skills. And it's like, nah, this is approachable. Like this is accessible to you. So how's that sound, Kjael? And I guess I should say you got Kjael here leading the thing, and we got Kjael riding shoddy. How we doing, buddy?
I was gonna say, everything you're saying makes total sense. I can be the real life scenario where you got a super technical focused guy coming in to do this work with you the last few years, and everything felt intimidating until we started hitting folks with analogies, doing these breakdowns. It's like your MBA training in real time once you realize, hey, this is not that hard.
Yeah. Or like it's doable. You know what I mean? You don't need to hire people. You don't need to get an MBA. You don't need to do any of that stuff. So anyway, all right, so let's start with net present value. We've touched on this quite a few times. And my favorite metaphor, or net present value, is basically like, and it is like, or I guess as Galloway says, there's kind of 2 elements that drive valuation. The value of cash flows right now, like basically what is the machine kicking off in terms of profit, which is very measurable. And then there's growth. And growth is interesting because, or theoretically, as the thing grows, the free cash flows or the EBITDA or the earnings should grow as well. And that's why you see people pay huge premiums for growth, because they're like, I'll pay a premium now, it's going to grow like crazy, and it's going to kick off way more cash in the future, and I'll pay a premium for that. And so net present value is basically saying, okay, if a business produces X in profit for a timeline, and it depends on your industry, but in SaaS, you're not looking out further than 5 years. The business is going to produce, let's say for K, this year, next year, boom, 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 the next 5 years. If we take all those cash flows and discount them back today, because there's a time value to money, right? You can invest that money in the S&P and earn 7.5%. There's erosive elements like inflation. So it's like, oh man, like I want to use my dollar today because it might not be worth more tomorrow. And if I invest $1 today, it's going to be worth more tomorrow. So there's this concept of time value of money. So we're going to discount that back to say, okay, this thing that's going to produce 500K for 5 years, like clockwork, today is worth this. So it's a very quantitative thing that's driven just purely on cash. So we want to start with net present value because that's a really good way to just establish like a point of departure or a foundational point of view on what the business is worth. And there's some things like terminal value and some other concepts that I left out because software moves so fast. And I guess this is just generally how we think about it. But I guess you could say anything that we're going to talk about today probably could undergo 2 or 3 greater levels of detail, but it's kind of diminishing returns at that point. Like you just need to understand these fundamentals and you should be pretty schooled. So by way of analogy, it's like, and I know you like this one, Kev. If you come up with a better one, let me know. But it's like, hey, this tree is going to produce this much fruit every year for the next 5 years. What's the tree worth today? That's the way to kind of think about it.
I like that. And then you discount the number of pieces of fruit that might spoil over that period.
Exactly. Or it's like, yeah, but weather's getting worse. And so this is where this concept of a discount rate, right? So you take those future cash flows and the calculator, you'll be able to look at the actual calculation so you can modify it however you want. But there's this concept of a discount rate that you include. So it's like, all right, we're going to take those future cash flows. We're going to discount them back today. That determines kind of a value. And then we're going to discount it by some percentage to accommodate for the time value of money, the opportunity cost, and just the risk. And so in private small businesses, or remember, in the S&P is like the benchmark, right? 10-year average is 7.5%, pretty much like clockwork. So it's like, all right, I can put my money in the S&P. I can trade it in and out. I can buy different stuff. I can buy options. I can do all this other stuff. It's as liquid as can be. For a private small business, I need more return than that. Like it's kind of like a hurdle rate if you want to think about it that way. So there's this concept of a discount rate, which goes into the calculation. We use 15%, which is double the S&P. So ideally, and I'm just going to talk through some concepts and then we'll step into the calculator live. And I did a Loom screen recording, so it's going to be a little bit redundant. And for the listeners, it might get a little bit weird. But anyway, so the net present value is that first thing where it's like, cool, I don't know much, but the cash flows for the business at steady state. And then this is where when we get into the model, you can start to see how you can tinker with growth, you can tinker with EBITDA margins, et cetera. But this is like pretty hardened with data point of view on valuation. And even if you just get there, happy days. Like, cool, you got a point of view. Next time something, it's like, I don't know, what's your house worth? It's like, I don't know. I heard people are selling houses in the United States for $10 million. It's probably $10 million. And it's like, oh man, probably not. Like, how many bedrooms you got? What neighborhood you live in, right?
Yeah. What's your square footage? What are your amenities?
The most important thing is like this net present value concept is kind of in isolation. So it's just a function generally of the cash flows. So what we need to do to round that out is to establish a relative, and we say relative all the damn time. So sorry, we sound like a broken record, but a relative point of view, which is like, okay, I know what the net present value of my business is in a vacuum. Let's go look at comparable businesses. Back to the house analogy. What are houses with 3 bedrooms, 2 baths in this neighborhood, attached garage trading for? And the challenge in our world is that it's very hard to get access to that data. But we're going to, we've kind of included a short list of really useful benchmarking data, which is half the battle, honestly, to help you there. And so there you want to isolate, and there's in the model as well, the whole plethora of variables, and it gets deep fast. And obviously beauty's in the eye of the beholder. So depending on if you are exploring an exit, whoever's looking to buy, you might weight certain variables more or less based on their context. But the kind of distilled version is profit margin, growth rate, gross margin, and customer retention. So those, if you're going to focus on any, those are the 4 that are generally pretty universal. So we're going to talk about grabbing benchmarks, scoring yourself, and then having that score turn into a composite score, and then that giving you either a premium or a discount to the average value of businesses that are comparable to yours. And now, oh boy, we're starting to get little nodes here that we can use to triangulate a point of view. So let's jump in. Should we jump into the model?
Let's jump into the model.
Any questions? And I know that this is well outside the technical operations wheelhouse, so I appreciate you bearing with me, Kjael.
Here for the long ride.
All right. So, and this is fun to play with. All right, so here we are. So let me bounce out a little bit just to orient you to the thing. So at the tippity top, we've got this net present value calculator.
Oh,
And
really quick.
but
You bounced out too far. That's way too small to see on the
way too
screen now.
small. I'm kind of trying to show the whole thing. Well, here, let me just do this real quick. All right, so we've got the net present value thing up top. We've got this huge roundup of all the variables that are in play. And then at the bottom, we have this benchmarking thing. And then at the very bottom, it triangulates your work basically up until that point. So let's zoom on in to something that's a little more reasonable. And then
There we
here's the
go.
Loom recording, which I'm basically going to say the same thing, right? So anything in blue, and this is a best practice in financial modeling, means it's an input, means you can change it. So if you remember, or kind of like the headlines here, so we're looking at, and TTM is jargon for trailing 12 months. So the first thing we want to do is say, okay, what was your ARR in the last trailing 12 months? Oh, let's, in this example, is 1.5 million. Okay, so that's this. Then in the prior trailing 12 months, what was it? And what we're trying to get a handle on here is year over year growth. So you input those two numbers and it'll spit out a growth rate. And there's a lot of difference in terminology, but here we have EBITDA or operating profit or earnings, however you want to think about it. Just think money that makes it all the way to the bottom line. What does that look like? And in our example, we said 350K. Okay, and then it spits out an EBITDA margin. So we're doing 1.5 million in ARR, about 350K in EBITDA or operating profit. That gives us an EBITDA margin of 23%. And so I'm going to introduce some concepts here that are, again, very approachable, but there's this concept of an add back, which it's very rare in small business world that the actual EBITDA is like a reflection of the earnings of the business. So there's this thing called add backs where you take non-recurring, non-required expenses. And a lot of times in like real SMB world, it's like, oh shit, my wife's car bill is on our P&L. And it's like, well, that's an add back. So there's like some weird stuff that you want to look for. But so let's say you brought in a marketing consultant to refresh some of your assets. You brought in a contractor to help with the engineering stuff for a quick sprint, but he was redundant. Whatever those are, itemize them and drop them in here, because what we're trying to establish is a point of view on adjusted EBITDA or operating income, so that we have kind of a course corrected, more real world point of view on the earnings potential of the business. So in this example, we had an operating EBITDA. I'm just going to stick with EBITDA from now on. We have 350K in EBITDA. We paid 100K to a marketing consultant for a one-time thing, and we paid 50K to a redundant contractor. It's like, okay, we're going to add those back. So that leaves us with an adjusted EBITDA of 500K and an EBITDA margin of 33%. So this is what we're going to be using to establish a net present value. But I did want to introduce another concept that's super relevant, which is sellers' discretionary earnings. So from your point of view as the founder, it's like, oh, cool, our business is spitting off 500K a year. It's like, oh, but I draw a salary and I'm 50-50 partners with the CTO and he draws a salary too. So that's where this concept of seller discretionary earnings comes in, where it's all in what kind of money or income are you taking from the business. So to calculate SDE, just drop in whatever the owner's income is. And then it's like, ooh, all right, the business is providing an SDE, a seller discretionary earning SDE of 800K. Happy days. But we're going to kind of leave that there, because the assumption is if somebody who's going to come and buy the business, they need a CEO and they need a CTO. So those things have replacement costs, as opposed to the add backs, which are like these weird things that aren't you shouldn't expect on a regular day. So we got that stuff. We've established a point of view. Then we get into kind of forecasting the free cash flows. And so the blue thing, like the way that we're looking at it is, and I guess the thing here is like, yeah, let's just forecast the business out for 5 years. And it's like, all right, we're putting up 36% growth and 23% EBITDA margin. It's like, that's pretty hard to endure and sustain for 5 years. So you want to be thoughtful about how you model that. And that's what, potential acquirers are definitely going to contest, right? It's that artistic kind of point of view on growth. So in this example, we've got, I downgraded a little bit, but we assume that, okay, and in the year that is 2025, and the main thing you want to be thoughtful of is adjusting the date. So here we said 1/1/26, which is basically like, all right, from this January 1st to January of next year, it's going to grow 36% and we're going to capture a 33% EBITDA margin. In subsequent years, for the next 4 years, it's going to grow at 20% and we're going to maintain a 30% EBITDA margin. All of that flows down to the bottom line to establish adjusted EBITDA, aka free cash flow. Yep. So it's all right. In 2025, we're going to do 680K in free cash flow. In 2026, we're going to do 730K, then 883, then $1 million, then 1.2 million. Cool. Now we've got a point of view on the fruit that the tree is going to create for the next 5 years. And we use, again, as mentioned, the 15% discount rate. And then here's this formula, which is literally X NPV, the discount rate, the times, this timing of the series, which is annual for the next 5 years, and then the cash flows, and blah, spits out net present value. So in this case, $3.4 million. And again, you like for a founder, they're like, damn, my business is putting up 1.5 million in ARR, growing 20%. Like we're at rule of 40. That seems like a low valuation. And I would say that it is, because there's premiums here, and that's basically, and like you want to be incentivized to sell the business. So it's very often when we get to the calculator where you're going to require a premium. It's like, this is what the business is worth today. To sell it, because I could sit back and collect these cash flows for the next 5 years, I need a 20% premium. I need a 50% premium. And we've thought through that and included it in the calculator when we get there. Kjael, how are we doing so far?
No, we're doing amazing.
All right.
This is really easy to follow.
Beautiful. That is my hope. All right. And then Software Equity Group, they're an investment bank, and they've got the dopest collection of what are just like variables. And so for the listeners, we have variables listed out, and then there's a column for weighting, and then basically a spectrum. So if we're talking about gross revenue retention, very high weighting. If it's sub 70%, you can expect a lower ARR multiple. If it's north of 95%, it's a higher ARR multiple. So it kind of gives you these bounds of like bad and excellent. And then the assumption is that the ARR multiple is going to fit somewhere in there without disclosing what those ARR multiples are, because that's where it's very difficult. And again, as noted, it's all private data, so nobody has access to, home sales. And then we go down to ARR growth, EBITDA margin. And then below, there's some qualitative factors like pricing model, delivery model, total addressable market. Anyway, this is a very productive table to just stare at and kind of digest. Cool. So now we've gotten oriented with the benchmarks. We're going to come down here and actually benchmark your firm. We're a big fan of scoring 1 to 4. If you go 1 to 5, you end up with a bunch of 3s, and it's like, man, shit, everything's down the middle. That's hard to, compare stuff on a relative basis. And here, let me bounce out a little bit. So, sorry, it's going to get a little small, but there you have it. I can't bounce in any closer. So anyway, we've got the 4 kind of king metrics that we consider king or queen are profit margin, ARR growth, gross margin, logo retention. And then we have ARR multiple and profit multiple. So the thing to call out is that we've kind of rounded up our select kind of top tier benchmarks. Boopos and Acquire are marketplaces. So what's interesting is that these are drawn from transactions, but you can also assume that like there's like some selection bias where the stuff that makes those benchmarks are the businesses that sell, and the businesses that sell probably have the best metrics. So like you can kind of continue to follow that line of thought. SaaS Capital is a firm that does a lot of surveying, and they extrapolate a lot of points of view from public SaaS data. So also extraordinarily useful. And then Benchmark It is just like straight up like benchmarking professional firm. So we've basically we grab whatever we can, and then we average them out across the sources. So for profit margin on average, and you can see like the average profit margin on Boopos for deals that's transacted was 68%. And I'm like, damn. That's
crazy.
That's a lot of free cash flow, baby. If you got that going on, you probably just want to hang tight. But
yeah,
anyway, so we end up
like,
at 48%. What's that?
Like, why sell if you got that much free cash flow? You can reinvest that into growth.
Taking 68 cents at home on the dollar. Damn. All right. So we've got profit margin at 48%, ARR growth at 24%, gross margin at 84%, and logo retention at 90%. Cool. This is your benchmark, and this is for private SaaS sub 3 million. So you want to try to anchor even closer with Benchmark It, or it's very hard to get to comps where it's like B2B, user-led growth, SaaS, selling to SMB, doing 500K ARR. Like you want to if you can, but it's very, very difficult. So you got to take some of these with a grain of salt. Like we're just trying to put you in the same zip code. All right, so the trailing 12-month numbers, then you're going to pipe and add your firm here. That's a cheeky little thing. You can type in your firm there. And then the profit margin and ARR growth are going to autofill from the exercise above for the net present value. And then just pipe in your gross margin and your logo retention. And so for our example, and I'm not going to go through each of these, but it's like, all right, our trailing 12-month growth was 33%. The average is 48%. All right, we're going to give ourselves a 2. We're just below average. But again, of all of these, that one's probably the most inflated. ARR growth, we're punching at 36%. Benchmark is 24. And let's juice that up to 3. Okay. And then so on and so forth. And when you're done, you're going to get an average score across those 4 dimensions. What happens now is it's going to basically the average. So 2.5 is down the middle. If this was a bell curve, a score of 2.5 would be perfectly average. So we take that score and we give you a premium or a discount. If you're punching above average, your ARR and profit multiple gets a premium. If you're punching below average, it gets a discount. So these things shake out where this firm should be trading at an ARR multiple of 3.7 times and an EBITDA or a profit multiple of 6.6x. Sorry for the listeners. That was a shitload of numbers. I always hate it when that happens when I'm in your shoes. So highly encourage you to peep this one visually because there's so much action here. But okay, so now we're going to triangulate.
Bing, bing,
Oh,
bing.
let's triangulate. Cool. So we're going to come down here. Part 4 is triangulating valuation, and I'll zoom in. I'll zoom up in here. So as I mentioned, an asking premium. So I would say 20% is pretty standard. But if we're asking based on a premium on net present value, we're like, we want 20% premium. Cool. The business value is 4 million, just north of 4 million, which is a 2.7 times ARR multiple and an 8 times profit multiple. And also there's a lot of debate as to which direction you want to skew. I would say generally SaaS, when we inherit a lot of this convention from public markets, where there's a huge premium on growth. So Bessemer and others, have kind of iterated on the rule of 40, which is your growth rate plus your profit margin. So growing 20% profitable, you're at rule of 40, happy days, you're considered elite. A lot of people have iterated on that to put a premium on growth, where the rule of X is actually 2 times growth plus profit. So back to our example, 20 and 20, it would be 2 times 20. So the rule of X, you've got 40 plus 20. So you're at 60. All to say that the growth is generally, there's a huge premium to growth because it goes on to inform the potential of future free cash flows. So if the business is growing like crazy and you're reinvesting in growth, like boom, 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 it's probably going to be an ARR multiple. If you've been at it for a while and the growth is kind of stabilized or it's descending and you're just kind of trying to generate income from it, draw cash, it's probably going to be an EBITDA multiple. Most convention in like the SMB entrepreneurship, acquisition entrepreneurship is like pure income. Like it's pure EBITDA multiples. They don't care about top line revenue. They're like, the tree is only worth what the fruit, right? Who gives a shit about the tree is kind of their point of view. So anyway, you got to figure out which side of the fence you're on, because obviously that goes a long way towards informing your strategy, especially if you're trying to position for an exit, et cetera. We can touch on that more in another episode, but
AKA know the goal of why you're running the companies. Like, what's your end goal?
100.
Right?
Yeah, totally. Begin with the end in mind, right? All right. So then we're going to basically pull the ARR multiple and the EBITDA benchmarks as a function or multiples from the benchmarking exercise. They drop right in here. But I would just encourage you to tinker with these. So I should have left them blue, but it's like, all right, what happens if we sell for 5 times? What happens if we sell for boom, boom, boom? And you're like, okay, this is kind of interesting. But all to say the ARR multiple spits out 5.6 million. The EBITDA multiple spits out 3 million. And we're going to take all 3 of those and average them out. And so we land at a blended valuation of 4.2 million. So
damn.
There is a lot of stuff that you could contest in this. There's varying degrees. Like you could get much more sophisticated, much more granular. Rest assured that, the more sophisticated audience is going to do that and building their models and blah, blah, blah. But in 15 minutes with call it, I don't even know, 15 inputs. At least when someone asks you what your house is worth, you're like, it's in the ballpark of 4.2 million. Or that's
at least you have an idea.
Or that's my reservation price. That's the floor. And I know that if we grow, if I can drive 40%, if we can punch from 35% to 40% growth, that's going to up our ARR growth relative to our peer. And that's going to up our average. And we're going to get a big premium. Happy days. Happy days.
Dude, that's when you go out and drink a cold one. Like that's a good feeling right there.
Like, ooh, we just broke 40% year-over-year growth. We know that had a huge outsized impact on our valuation. Break out the champagne. Holy macaroni. All right.
So I would say in summary, understanding, or beginning with the end in mind, going through this NPV kind of exercise really helps you to understand, like, at what point in time should you strategize that exit if you want to exit, right? And then how do you come up with your valuation for that exit? What is your argument to defend that exit price? So yeah, no, this was good.
Totally. Yeah. And then there's some other stuff too that's kind of connected, like in terms of, like, if you've been at it for 5 or 10 years, and you think about portfolio construction and some of the theory around that, it's like diversification is king. And back to the exercise where it's like, all right, well, at least now you understand the value of your greatest asset. Now we need to have a conversation about how concentrated your wealth is in that asset. So it's
Yes.
like you are anti-diversified. 80 or 90% of your net worth is in one thing. You know, if you're starting to feel a little crispy, a little burnt out, you're starting to wonder about some other stuff, it's probably very conducive to take some chips off the table so that you can diversify, because you've really consolidated your risk up until this point. So it can go on to inform a bunch of decisions ultimately. And, you know, it's just knowledge is power. So, and I think it's a shame, honestly, up until this point that, you know, and this is the system. It's a systemic thing where it's like, if we just scare the shit out of everyone to make them think that they can't figure it out, then they'll never figure it out and we can exploit them all. And it's like, that's not really how society rolls these days. Hopefully this is productive. If you want to run through this together as a founder, we're here. You want to talk through metrics, value creation plans. This is the stuff we obviously geek out to. So I'll leave it at that. Much love for the love of the game. All right, Caleb. The next one is all you, buddy. I'm going to sit there.
All right, we'll map out vectors, ICP segments.
Yeah. All right, my guy. You have an outstanding rest of the day. Pleasure as always. Peace.